This is the Chapter 8 pre-class lecture, Reporting and Analyzing Receivables. After studying this chapter, you should be able to do all of the following. You should be able to identify the different types of receivables. You should be able to explain how accounts receivable are recognized in the accounts. You should be able to describe the methods used to account for bad debts. We'll talk about what bad debts are. You should be able to compute the interest on notes receivable, describe the entries to record the disposition of notes receivable. You should also be able to explain the statement presentation of receivables, describe the principles of sound accounts receivable management. You should be able to identify ratios to analyze a company's receivables and even describe methods to accelerate the receipt of cash from receivables. In our pre-class lecture, we are going to be covering learning objectives 1, 2, and 3. So before we dig into the details of receivables, let's talk about the different types and make sure we know the different types of receivables and what they are. The basic definition of receivables are in the top box, and they are amounts due from individuals and companies that are expected to be collected in cash. So these are IOUs from your customers. Okay, you sell something to them and they don't pay you right away, but you either invoice them or you say, pay me in a month. Those outstanding IOUs are receivables. There are different types of receivables that are outstanding, and those are these 3 boxes. The first type of receivable is an account receivable, and what that is it's amounts customers owe on account that result from the sale of goods and services. So again, the example I just used, if you sell something to your customer and they don't pay you right away, they're going to pay you a little bit later, that's called an account receivable. There's also another type of receivable, which is a written promise, a more formal instrument for an amount to be received. And these are called notes receivable. So we've got accounts receivable that come about through normal sale of goods and services. And then we've got these more formal instruments that are notes receivable, that you actually write a note, kind of like a little mini loan, if you will. And we'll talk a little bit more about those later in the chapter. And then the last type of receivable just is a catch-all, other receivables. Companies often have non-trade receivables, such as interest receivable or loans to officers, advances to employees, income taxes refundable. Those types of things are amounts that are expected to be collected in cash at some point in the future, but right now they're outstanding IOUs, and so these are other receivables. In class, we talk about one loan that WorldCom, the company WorldCom, made to one of their CEO. They made a $400 million loan to their CEO, and we'll talk about the reasons why they did that. But WorldCom decided to make this loan to the CEO, and that $400 million loan to an officer of the company would be recorded in this other receivable section on the balance sheet on WorldCom's financial statements. Okay, so we've talked about the 3 different types of receivables, and we've defined what receivables are, and again, it's in that top box, amounts due from individuals and companies that are expected to be collected in cash. And this is a slide that just shows receivables for these different companies, these companies that we've heard of before, and their percentage of total assets. Some companies have a very large amount of receivables, outstanding receivables, as a percentage of their total assets. General Electric, more than half of their total assets are receivables. Ford Motor Company, 42%. 3M is much smaller, 14%. DuPont, 17%. And Intel is only 5%. So there's no magic number as to what mix of assets should be receivables. Different companies operate differently. They have different credit terms, perhaps. They sell more things on account, so they may have more outstanding receivables. Okay, so we've identified the different types of receivables in the previous slides. Now what we're going to talk about is the second learning objective, which is explaining how accounts receivable are recognized in the accounts. So there's 2 issues that we have to discuss when we are talking about how we recognize receivables in our financial statements. The first is recognizing accounts receivable, and the second is how do we value these accounts receivable. We need to first identify what truly are receivables, and then we need to figure out what numbers should we be recording for these receivables, what value should we place on them. So when we talk about the first issue, recognizing accounts receivable, we need to keep a couple of things in mind. Are we talking about a service organization? If we are, we need to keep in mind that if we're talking about a service organization that doesn't sell actual goods but sells some sort of service, you would record a receivable when the company performs the service on account. So whenever the service is performed, that's when you would record the outstanding receivable, and that's when you would recognize the receivable. For a merchandising company, a company that sells goods, sells stuff, you would record the account receivable at the point of sale of the merchandise on account. So a customer walks in and buys something from you. At that point of sale, that's when you would book the outstanding account receivable. Okay, so for the next few slides, I want to kind of walk through the debits and credits of how receivables are recognized in the accounts. And so the best way to do that is just to kind of walk through and discuss some items and journal them as we go along. So we're going to assume that we've got a company, Jordache Company, and assume that Jordache on July 1st, 2014 sells merchandise on account to Polo Company for $1,000 under the terms 210 net 30. And what we want to do is we want to prepare the journal entry to record this transaction on the books of Jordache Company. Quite simply, how you would do that is the customer walks in and they're buying something from you. They're buying merchandise, and so you would, at the point of sale, record the outstanding receivable, because that's the point when you can recognize it, and you sold them $1,000 worth of stuff, so the amount that you would record would be $1,000. So you would debit your accounts receivable to increase the asset accounts receivable, and you'd credit sales revenue because you have done what you needed to do to recognize that revenue and record that sales. So debit AR, credit sales for $1,000. And as time goes on July 5th, a few days later, Polo returns merchandise worth $100 to Jordache Company. So you sold, on July 1st, you sold $1,000 worth of stuff. On July 5th, they walk in and they return some of it. Totally a normal part of business. We need to know how to record a sales return. And quite simply, what you're doing is you are removing those items out of accounts receivable because they no longer owe you that amount. They're handing you back that merchandise, and so you need to reverse the previous sale, basically. And you almost do that by just debiting sales and crediting accounts receivable, but instead of debiting sales revenue and just kind of reversing out the sale, there's a sub account or a contra account that you would debit called sales returns and allowances. So your debit goes to a new account called sales returns and allowances, and your credit goes to zero, or to back out the outstanding receivable for that $100 worth of merchandise that they owe, or that they returned rather. So as of July 5th, you sold $1,000 worth of stuff to Polo, and then they brought back $100. So now the outstanding receivables has a $900 balance. On July 11th, Jordache receives payment from the Polo Company for the balance due. So the terms of this sale were 210 net 30, which means if they paid their amount due in the first 10 days, they would receive a 2% discount, sales discount. 210 means you get a 2% discount if you pay the amount due within the first 10 days. If not, the net amount is due within 30 days. 210 net 30 means you get a 2% discount if paid in the first 10 days. If not, the total amount is due in 30 days. Since it was July 11th, which is 10 days later, they do take advantage of that sales discount. And so basically, they are paying $882 for the outstanding receivable of $900. So what you've got to do is you've got to record the fact that you've received $882 cash by debiting cash for $882, and you need to zero out their receivable, and you would do that by crediting accounts receivable for $900. So now there is no outstanding receivable balance from Jordache because they are paying their balance due. The difference between the $882 in cash that you receive and the $900 of outstanding receivables that they're paying is a sales discount. So a sales discount is just the 2% discount that they took off the $900 or $18. That's another, just like sales returns and allowance, that is another contra account to your sales revenue. And so that reduces the overall value of your sales revenue by another $18. Let's talk about another incidence of when you might encounter as a merchandising company when you are dealing with accounts receivable. Some retailers issue their own credit cards. Assume that you use your JCPenney company credit card to purchase clothing with a sales price of $300. So when you use your JCPenney credit card and you go buy merchandise from JCPenney, they, as JCPenney, make the following entry. They record an account receivable of $300 because they've got an increase in an IOU from you, the customer, and they're crediting sales revenue for $300. They've earned that revenue. And now assume that you owe $300 at the end of the month toward that credit card, and that JCPenney charges 1.5% per month on the balance due. At that point, you are now, if you haven't paid off that $300 and haven't made any payment against that account, you are accruing interest from JCPenney or against your JCPenney card, and actually JCPenney is actually earning an additional interest from you. So what they do is they debit accounts receivable for $4.50 or 1.5% of the $300. So now you owe them $304.50, and they're earning an interest revenue that they credit for $4.50. Okay, so the previous slides covered learning objective number 2, which was explaining how accounts receivable are recognized in the accounts. And we talked about how they are recognized and walked through some debits and credits examples of where they would show up in the accounts. Now what I want to talk about is how to value accounts receivable. And before we talk about that, we need to talk about the fact that talk about reality. Customers walk in all the time and buy things on account, and then a company will invoice them and say, okay, you owe us for that stuff that you bought from us. Well, the reality is 100% of your customers are probably not going to pay you back. There are going to be some customers, by no fault of their own perhaps even, that are never going to pay you back the money that they owe you. Maybe they go out of business. Maybe they go bankrupt. Maybe, they just skate out on their IOU that they owe you on their outstanding receivables. Whatever it is, we've got to account for that in our accounting records. The fact that we've got these outstanding receivables that are probably not going to be collected. So when we value accounts receivable, we value them as a current asset, and we put a value on them, or we try to come up with what's called the net realizable value. How much do you think you are going to realize from all of your outstanding receivables? It's not realistic to say that the net realizable value is 100%. You probably won't get 100% of all the outstanding receivables, but it may be more realistic to say that 95% of them will be realized. So we're looking for a net realizable value to record on our financial statements as a current asset when determining what the value of accounts receivable should be. And so we've got these uncollectible accounts receivables, which are basically sales on account that raise the possibility of accounts not being collected. And so what we need to do as the seller, we need to record these losses that result from extending credit to our customers as a bad debt expense. And it actually shows up on our income statement as an expense. It's a cost of doing business. Because we have given all of these customers merchandise on account, a cost of doing business is the fact that they won't pay us back everything that they owe us. So we need to record a bad debt expense. When we are talking about bad debt expense and recording these uncollectible accounts, there are a couple of different ways that you can do this. One of them is the direct write-off method. This, however, I don't like to spend a lot of time on it because it's theoretically undesirable. It does not match the recording of the expenses with the revenues that you've earned from selling that merchandise. The receivables are not stated at this net realizable value, and it's not actually acceptable for financial reporting. It's not GAAP. But there is this method called the direct write-off method, and basically what it is, it makes you wait until you know that these customers will not pay their bills, and at that moment you would then write off their account. What we do instead is called the allowance method, which is in this box on the right. And the allowance method is where losses are estimated. So again, you sell to 100 different customers and you make a guess and go, you know what, of all of the 100 customers, I think 5 of them are probably not going to be able to pay their amounts due. And so you come up with an estimate of what you think your uncollectible accounts are. So there's better matching because you are taking a best guess as to what your expenses should be in the period that the revenues are earned related to those receivables. Receivables are stated at the net realizable value because you've worked into the accounts receivable this amount of losses, and it's actually required by GAAP. Okay, so let's kind of walk through how this works on the balance sheet. We've got 2 T accounts on this slide. One of them is for accounts receivable, and that's your asset. That's where you record, anytime you record a sale on account, you would increase your accounts receivable by debiting accounts receivable and recording it on the left. And now we've got a new account called allowance for doubtful accounts. And what this is a contra account to your accounts receivable to be able to record your net realizable value. The net realizable value of accounts receivable is accounts receivable minus your allowance for doubtful accounts. So the allowance for doubtful accounts is a contra asset that goes to reduce the value of your accounts receivable, and so it naturally has a credit balance. If you looked at it on a balance sheet, you would see that you've got your accounts receivable amount for $500, and then right underneath it you've got your allowance for doubtful accounts, which is your contra asset that goes to reduce the overall value of your accounts receivable. So your net realizable value for accounts receivable is $475. Lots of balance sheets show it this way instead. It would show your accounts receivable with the allowance all on one line item. And so it would just say accounts receivable, comma, net of $25 allowance. And so it would show your net realizable value of $475 without breaking it down into 2 line items. Okay, so I want to walk through the debits and credits of selling something on account and recording your allowance for doubtful accounts and writing things off and going through the collections of receivables. And the best way to do that is to kind of journalize it and show how it is affecting your accounts via these T accounts. So let's say that we have a credit sale of $100. When you sell something on account for $100, you're going to debit your accounts receivable, increase your accounts receivable by $100, and you're going to credit sales for $100. So your accounts receivable goes up by $100, which gives you a $600 balance in accounts receivable. Your allowance does not change based on that sale. Now let's say you collect $333 on account. So someone walks in and says, I'm paying off my bill, I owe you $333, and here it is. So you debit cash for $333, and you would credit accounts receivable for $333. So now your accounts receivable balance has been reduced down to $267, and again, your allowance hasn't changed at all. Now let's say we need to make an adjustment to our allowance for doubtful accounts. We think that the $267 of accounts receivable out there, we think that $25 of an allowance is not big enough. So we need to beef up our allowance for doubtful accounts. And the way you would do that is you would record a debit to bad debt expense and a credit to the allowance. So whenever you are making an adjustment to your estimated bad debts, you record a bad debt expense debit and a credit to your allowance for doubtful accounts, and that increases your overall allowance for doubtful accounts. So now you've built up your allowance up to $40. So in the previous step, we built up our allowance to $40. Now what happens if we need to write off an uncollectible account for $10? So we've got $267 worth of outstanding IOUs from our customers, and one of them walks in and says, you know what, I owe you $10, it ain't happening, I am not going to be able to pay you back. Well, that's the point where you would write them off. And the way you write them off is that you have to remove them from your outstanding receivables. They've told you they're not going to pay you back. So you remove them from your receivables by recording a credit to accounts receivable to reduce that amount and take it out of accounts receivable. And now you've built up this allowance, you've built up this outstanding allowance for cases like this when people walk in and say, I'm not going to be able to pay you. So what you need to do now is you need to use part of your allowance. And the way you do that is you debit your allowance. So you had a $40 cushion, if you will, in your allowance for doubtful accounts, and now you're using $10 of it. So you would debit allowance for doubtful accounts and you credit accounts receivable when you write off an uncollectible account. Now, after these transactions have occurred, you've got an outstanding balance in your accounts receivable of $257, and you've got a $30 allowance. So on your financial statements as of this point, your net realizable value is $227 for your accounts receivable. Okay, so we have talked about the debits and credits, and we've looked at the financials as to how this is recorded. I mentioned there were two different ways to write off uncollectible accounts. One of them is the direct write-off method, which we don't really like. The other one is the allowance method. I want to go back to the direct write-off method just a minute and show you how it works, even though, again, it is not GAAP, it's not acceptable for financial reporting, and it's definitely theoretically undesirable. But let's assume that Ward & Company writes off M.E. Doran's $200 balance as uncollectible on December 12th. Warren's entry, when you write off your bad debt, or when someone walks in and says, I'm not going to pay you this $200, you would at that point, under the direct write-off method, you haven't built up any allowance like you had in the previous slide. All you would do is you would at that moment record a debit to bad debt expense because you're not getting that back, and a credit to accounts receivable because you need to remove that outstanding IOU since you will never receive it. So under the direct write-off method, there is no allowance for doubtful accounts because you haven't built up that allowance. You just record an expense, the bad debt expense, directly when they come in and tell you, I'm not going to be able to pay you the $200. Under the allowance method for the uncollectible accounts, companies have to come up with an estimate for the uncollectible accounts receivable. So how did they get that $30, or how did they get that $40 from our previous slides? Well, they have to come up with an estimate, and we'll talk about that in just a minute in a couple of different slides. But basically, once you come up with that estimate, you would debit bad debt expense, and you would credit the allowance for doubtful accounts. So you'd make an adjusting entry to debit bad debt expense and credit your allowance, which is that contra asset account, to build up your allowance to allow for any people that aren't going to be able to pay their bills in the future. And then you would debit the allowance for doubtful accounts and credit your accounts receivable at the time this specific account is written off as uncollectible. And let's kind of walk through an example. Hampson Furniture has credit sales of $1.2 million in 2014, of which $200,000 remains uncollected at December 31st. The credit manager estimates that 12,000 of these sales will prove uncollectible. So they sell $1.2 million worth of stuff. They have an outstanding receivable balance as of December 31st of $200,000. And the credit manager has looked through all of these $200,000 that are owed, and he estimates that 12,000 of these sales will prove uncollectible. So what he needs to do is on December 31st, he needs to make an adjusting entry to build up the allowance by $12,000, assuming there wasn't a previous balance there. So to do that, to make that adjusting entry, he would debit bad debt expense for $12,000, and he would credit the allowance for doubtful accounts for $12,000. And again, bad debt expense is an expense, shows up on your income statement. It's a cost of doing business. And the allowance for doubtful accounts is a contra asset account to reduce the overall value of accounts receivable on the balance sheet. You'd see that on Hampson's financial statements, either in 2 line items like this, or they might smush it all in one like we've seen in previous slides. At the end of the year, on December 31st, they have accounts receivable outstanding of $200,000, less their allowance for doubtful accounts that they've just allowed for of $12,000. So their net realizable value is $188,000. And then if we keep going, the Vice President of Finance of Hampson Furniture on March 1st, 2015, authorizes a write-off of the $500 balance owed by R.A. Ware. When you record this entry, when someone walks in and says, you know what, I owe you $500, you aren't going to receive it. I've gone out of business, I've gone bankrupt, or what have you. When you deem that the amount is uncollectible, that's when you dip into your allowance. When you dip into your allowance, you use part of it, and there's a $12,000 balance there. The way you use it is you debit your allowance for doubtful accounts. So you've used $500 worth of that allowance for doubtful accounts, and the balance after you write this off is now $11,500. And then the other thing you need to do is you need to credit accounts receivable, because you now are no longer expecting to receive that $500 from your customer, Mr. Ware. And one more little thing to go through before we end this pre-class lecture. What happens if R.A. Ware comes back on July 1st, a few months later, and says, oh, just kidding, I know you had written me off. I told you I had gone out of business, or I told you I had gone bankrupt, but I came into some money, and so now I want to pay you the amount that I owe you. So on July 1st, Ware pays the $500 amount that Hampson Furniture had written off on March 1st. So what does Hampson need to do? Well, on July 1st, they need to do 2 things. The very first thing they need to do is they need to reverse the entry that they made on March 1st to write off this account. On March 1st, we had debited the allowance and credited the accounts receivable for $500. So on July 1st, we need to reverse that and put the amount owed back into accounts receivable by debiting accounts receivable for $500. And we need to unuse that allowance, if you will, by crediting the allowance and putting that $500 back in the allowance. After that, we need to record the fact that he made good on what he owed us. So he has an outstanding accounts receivable because we just put him back into our outstanding accounts receivable, and now he's paying for it. So we need to debit cash because we're receiving $500 from Mr. Ware, and we need to credit accounts receivable for $500 to show that we no longer have that outstanding receivable. Like the write-off, a recovery does not involve the income statement in any way, because we're just using that, we're putting the allowance back to what it should have been, and we're reducing the overall value of our accounts receivable again because he paid us cash. And this concludes the Chapter 8 pre-class lecture.